Welcome all, and today we have an amazing guest, Caleb Basili, who is a CPA. Not my usual style, I've got to say, considering my accounting is not so good, but he is a specialist in quality of earnings. So, welcome, Caleb. Great to have you on board.
Thank you, Craig. I'm looking forward to this podcast.
It should be a bit of fun. There's just so much. I've been looking through your LinkedIn, just doing my research before this, and you've got so many great articles on there. It's not just on quality of earnings, it's about whether things are a good deal, whether they're not. But there's one in there which is a bit of an etiquette question that I thought I'd bring up. And that was, should you renegotiate a deal after due diligence? And there's so much in that you don't want to really be the nasty person and try and screw people to a wall. You need to actually have a fair deal in place. Otherwise, it's not going to work for anyone. So tell us about that one, if you could. What are your thoughts on that, on renegotiating a deal?
Yeah, that's a really good question. I appreciate that. So there's two schools of thought, essentially, and I think that the truth is somewhere in the middle. One school of thought is essentially you really shouldn't ever renegotiate a deal. You make an offer, you do your due diligence. As long as there's nothing crazy bad, you buy the company. And that school of thought is typically more for larger deals where you do the due diligence, nothing big or nothing horrible comes up, and maybe your numbers come in like 5 to 10% lower than the original seller's numbers, and there's nothing crazy bad, but it's a little bit worse than you originally thought, but you should still buy the deal at that amount. The other school of thought is, hey, no matter what, you should always renegotiate. You go in high to get the offer accepted, then you prove to them why as to you should renegotiate. So let's say their numbers, and this is more common for the smaller deals. Let's say their numbers are 1 million EBITDA. Your numbers come in at 900,000 EBITDA. So it's just a little lower. You should always renegotiate, even if it's just a little bit. And I feel as though the truth is somewhere in between. There are times where you definitely need to renegotiate so that the numbers work for you, they work for the bank, and they make sense to the seller and the seller can understand them. For instance, the seller's numbers, even the numbers are 1 million, you go through the due diligence and find out that your numbers will be around 800,000 if you buy the company. And so it might make sense to ask for a 20% haircut because the sellers are a little too optimistic with their numbers. Or on larger deals, or even on smaller deals as well, is if the percent difference isn't too high, it doesn't really make sense to renegotiate. It could look bad to both the broker, the seller, and then it could just frustrate everyone. So really be careful if you're going to renegotiate.
It also, it's a, I'm in Australia. It's a small industry. You'll get known for that pretty quickly if that is
It
your
is.
standard way of practicing. A mentor of mine, a gentleman that we probably all know, Hugh Hilton from the Hilton family, he tells a story about where he was putting in an offer in Silicon Valley for a large factory and a block of land to go with it. And again, it doesn't matter. Within the industry, it's a small industry. He knew the other players in the business as well. So what he said was, I would put my offer in person rather than written. Well, that of course gets him in front of the right people, which other people didn't do. They just sent through the piece of paper. But he went in front, got in front of them, and he said, look, he said, you may know these other players, and he rattled them off. He said, what they tend to do is they'll go in high, and then once they get in and through the door, they'll then start to cut the price. He said, I'm here. I'm not going to do that. I'm going to put an offer in right now and we can make this happen right now. He has a unique style, Hugh Hilton, but that was his take on it. He actually called it out on people to
Mhm.
put a spotlight on them of these serial offenders, basically. So that's why that article of yours I thought was quite interesting, because Hugh Hilton just really had a great story to go with that, I thought. So,
Hmm.
okay, well, we should get back to a bit about what you actually do, shouldn't we? So tell me, you run a website called QOEprep.com. No guesses as to what that stands for. I'll hand over to you on that one.
I appreciate it. Yeah, it just means quality of earnings preparation. When I left my original company, Baker Tilly, I started a service of preparing the quality of earnings report for other firms where I worked as a consultant for them. I had up to 6 firms at one time. And essentially I said, hey, you sell the deal, I'll do the work. I'll do it from beginning to end, and you can sell it under your own company's name. I didn't see myself as a salesman in the past. I saw myself as an Excel guy, an accountant, a CPA, and I'm like, those two things should never collide. There's two different skill sets, and it is, but you can become either. And that's what I'm on my journey doing. And I appreciate you taking time to meet with me, because I know that I can learn a lot from you. And so QOE prep stands for quality of earnings preparation. And now it's
Yep.
become, hey, I'm doing deals on my own as well.
And these quality of earnings, you don't do just QOE. You go through the P&L, the balance sheet, reconciliations, customer concentration risks. You go through the whole gamut of the due diligence and the risk assessments.
Correct. Yeah. So, like, the biggest question a buyer wants to know is, will this investment pay me back? Essentially, am I
I want my
overpaying?
money back, and when do I get it? Is what I want
Yeah,
to know. When do I
exactly.
get my money back?
Yeah. And then they also want to know, like, what are the risks with this company?
Mm.
They don't want to know that. They should know that. So I look at it for them. Yeah, I've worked on 200 of these acquisitions. So I kind of,
200.
yes.
Most people would, okay, now let's stick on that. 200. You've done 200 from the start to the finish. Now, most people, when they look at a deal, they'll look at, it'll take, I want to find a deal in the first 5 or 10 that I go looking at. But really, it takes 100 to actually find a good deal and find an appropriate one, a business to buy. So you've actually made it through that process and then done the assessments on 200. So you actually know what you're doing by the sound of it then.
Yeah, and I do have to pause and say, of those two, a lot of them have been with team members and with other people, and
Hmm.
I've been doing work on behalf of those other companies. So it's not like I've done 200 completely under my name. I'm signing off on it. There's been a mix of it, but yeah,
Always the way. We always work in a team,
yep,
because with the due diligence, I said you go right the way through the due diligence. Well, you do the financial due diligence. You don't do the property due diligence, the
correct.
personnel, all of that sort of stuff. So we're always in a team. But I said at the intro here, CPA, and frankly, those letters scare me a bit, because that is not who I am. I went to uni, and yes, I failed accounting twice. That was the first level of accounting. It just isn't my thing. And the thing is, I supplement that by hanging around good people. I've got a good team around me to do
Hmm.
that. But I don't want to be responsible. I don't want to have to go out there and do these QOE reports myself. I would imagine that I would be capable of doing it, but I'm not going to be able to do it as well as someone that's done 200 of them. Simply put, I wouldn't know the red flags to go looking for, and therefore it's going to put it at risk. And that's where you come in, because you're removing or reducing that risk enormously.
Yep, yeah. Well, a lot of people fail accounting, even people in business school. It's not a, it's not the easiest course for two reasons. Number one, it's number based. And number two, I forget the guy that made accounting, I think the double book system, I think his name was Masari. To me, it's not the most intuitive thing. So you kind of have to learn a new language of accounting. And it's not like
Yeah.
geometry or algebra. It's not like a normal math language. It's a little bit different. So you have to learn that new language and then you have to start working in it. So it's almost like you're taking classes in another language. That's how I see it
Well,
as.
it's not for me. My
Mhm.
granddad had a saying, why have a dog and bark yourself? So, in other words,
Yeah.
why why do all the effort when you've got a professional there? And that's what you are. In the politest possible manner, you're a tool, a very valuable tool to you
Yeah.
to have in your repertoire.
Yeah. So believe it or not, in the United States, the term dog now has a really good definition. Like if you're called a dog and like a sport, they view as you as like a very like good player, well-rounded.
Okay, I didn't know that.
And like
In
you're yeah.
in India, I
Uh-huh.
don't know what do Americans call Indians? South Asians or something?
Mhm.
Yeah. In India, the country India, dog is a bad word. It's not
Yeah.
a desirable thing. Yes,
Yeah.
it's you've got to know these things. Okay.
Well, no, I mean, I would not call someone a dog unless you understand it. In a sports context. It's like, man, you're a dog. Like you just caught that touchdown or scored that
Hmm.
goal in football, and like it was something hard to do. So like, yeah, it's kind of interesting.
Okay. So who are your clients? Who are the people that would come to you? And why should we come to you? And when should we come to you?
Sure. So I can start working on a deal. If it's a buy side deal, I can work on it once the LOI has been signed. And I'll work for people who are in private equity, who are rolling up certain types of companies. Work for individual buyers who are buying their first company. They're like MBAs out of like a big school and they want to buy a company and run it. I'll work for investment banker on the sell side. Have connection with investment bankers. They'll send me deals to kind of prepare the financials. Hence the name QE prep comes into play here. I'll prepare the
Hmm.
sell side financials and get it ready for the sim. And it basically gives the sellers confidence that their numbers won't change a lot when the buy side due diligence comes in. So sell side due diligence is becoming more and more common, even for deals as low as 10 million in revenue.
Sorry to interrupt. I just want to ask, go through a bit of a flow on this on that subject if I could. So, okay, for me as an example, what I'm doing is I'm racking and stacking a whole heap of dental practices into a back-end shared services ready for a carve out for a private equity firm. And one of the advantages with that is that all the financials, everything is fully documented, standardized, and reliable. As part of the carve out process, it is my intention to go through and get those financials reassessed so that by the time I get to the PE, I can make things look good and make them attractive. Now, there's a saying that I learnt years ago of someone that I believe I introduced you to recently, a gentleman called Rick Otten. And his saying was, how do you sell something? You make it easy to buy. So, what I'm getting from what you're saying there is, as a seller, you get the prep work done and it adds value to the whole deal as a whole, thereby making you more attractive. Is that what I'm extracting out of those few words you said?
Exactly. Yeah. I'd look at it as selling your own home to someone. If someone's about to come into the home, are you going to clean your house and organize it? It's kind of with your financials. So some people really care about numbers, almost more than
Mm.
operations. They're kind of weird. You're looking at one of them. But so when anyone on your team, you're going to have the operator, the finance guy, the legal guy when they're looking to buy a company. So if the finance guy
Yeah.
goes in and says the numbers are a mess, typically they're pretty like just straightforward. The numbers look bad. It doesn't mean that the company is not making money, but it's going to slow down the process for several reasons. One, you have to get your numbers ready before selling. Two, It's more likely that if the numbers go one way, it's going to go down because the buy side due diligence will bring it down. Because CPAs, we'd say we're realistic compared to a seller and an investment banker. We're going to be pessimistic, not on purpose, but just because we go based off of the numbers. And if we see something as one time and not recurring, we're going to flag it.
Mm.
Yeah, so I think that's why sell side quality of earnings is getting more and more popular. And then for like your dental practice, something that a lot of people are liking to see is like if it's a lot of individual dental practices, you're going to want them in a similar accounting system with a similar chart of accounts so that it's easy to compare them.
Yeah, I agree, though I don't understand and I don't have to because there's good people out there that do. And we get those in to do it. Now, there's something else. Today I had a message from someone and they're looking for a fractional CEO. So, from your perspective, you would be dealing with fractional CFOs as well. Would that be a reasonable thing for you?
Is that a service I provide right now?
Yeah, you would deal with the fractional CFOs on the purchase and the
Gotcha.
sales. I'm interested in how you deal with and relate with the fractional side.
Yeah.
Does that work for you? And how do you feel about that?
Think it's a great service. I really do think it's good. I personally don't offer fractional CFO services because I want to focus on quality of earnings
Mm,
reports.
of course.
However, for like a large company at 100 million, they're going to have a full-time CFO. Companies under like 3 million, they won't have a CFO. So and then anywhere between 3 million and 100 million, that's a great place to be as a fractional CFO. And it might make a lot of sense for a company to hire a fractional CFO because they want someone who's going to look at their numbers and help guide them in both growing and also they want someone to tell them the story of where they've been. So that it's really good to have a fractional CFO if you can't hire a full-time one yet. I definitely think there's a strong need. Technology is allowing fractional CFOs to be able to help more companies at a time.
I would have to agree. And then, of course, AI is going to come into this very soon. If it's not already there, it's going to come in and be an influencer in this. Now, you have weekly meetings as well, I understand, for people involved with this. Is that correct?
Yeah. So every Thursday at 11 a.m. Eastern, so right before you go to bed, Australian time, I imagine, is around midnight. How many hours are you off of? What time is it for you right now?
Right now, it's 8:06 p.m. here for me,
Okay. Yeah.
but
So 1
it's your
a.m.
tomorrow.
Yeah. So I guess that's for you Friday at 1 a.m. I host a coffee chat where I bring on a special guest. We talk about
Okay.
something to do with buying a business or selling a business. And it's just a chance for people to come in, listen, and then ask questions. I really like making the meetings more about what's on people's mind. So I'll present for 5 minutes. My special guest will present for 5 to 10 minutes, and then we'll just let the audience ask questions.
Very good. Okay, well, we will grab the details and they will be at the back end of this podcast, by the way. So we'll grab those details off you and stick at the back end
Appreciate it.
and get people along to that, I think. From my side of things, of course, you need the coffee with that one because if you're going to be talking accounting stuff, I'm going to need we'll just get it intravenously, I think.
Believe it or not, it's also, we talk about so much more than just accounting.
Excellent.
Yeah, it's
Excellent.
more kind of like the process of buying a company, what to be aware of.
Okay.
Customer concentrations, like what do you do if there's like one customer that takes up 40% of the revenue? What do you do with vendor concentration risk if there's like a few vendors that basically sell you all of your cost of goods sold? Stuff like that. So it's not just accounting, it's a lot of operations as well.
Okay. So you're very risk oriented there in highlighting the risks and working your way through those.
Yeah, I'd say we do that a lot. And then we also talk about opportunities too. So like the whole like private equity playbook. We'll talk about that as well.
Well, if you go into the private equity playbook, we have to mention Adam Coffey, don't we? We're talking coffee breaks here and He
Oh,
wrote the
yeah.
private equity playbook. That was his first book. So yes, we have to mention Adam at this stage, who I'm catching up with again in 2 months, which is nice. He's coming over to Sydney to see me, so that's going to be very nice. Looking forward to that.
Yeah.
Okay, so what else did I have here? Now, the quality of earnings, your actual work rather than everything that we've been chatting with as well. How long does it take? Or is that how long's a ball of string? How long does it take to go produce a report and get that analysis done?
So we try to take on only enough clients to where we can do every quality of earnings report in just 2 weeks. And that's once the seller provides the data. For buy-side diligence, it's really important to the buyers and the sellers that we work fast. On a sell side quality of earnings, the time frame really isn't as important because there's no one under LOI. So there's not like a tight time frame. And a lot of times a seller is going to say, hey, do the quality of earnings report for me and tell me what I need to do to sell for more. So it's not like, hey, I need to sell within 2 months. So get this done as fast as possible. They see it as a learning process as well. We could still do the sell side quality of earnings in 2 weeks, given that they already have the data ready. However, that's not always the case.
Okay. So you say the data. So what I imagine is you've got a checklist or two and you say, here, send this off, get me all of that stuff and come back to me. And if you've given
Yeah.
it to me, we're good to go. If not, I'll be pestering you for more stuff.
Yeah. Yeah. And the data basically boils down to access to the accounting system, bank statements, payroll reports, tax reports. Those are the main 4 items that we look at. And within the accounting system, it's the profit and loss, balance sheet, vendors, customers, statement of cash flows, and then a little bit more as well. And then depending on industry, we might ask for more data as well. I don't want to bore your audience with the data though.
No, that's okay. Okay.
I could get a little too detailed.
I think it's in your job description, so we'll forgive you for that. But let's talk about this due diligence side of things. The due diligence, we hinted before, you're not the only component here. You've got the legal side, you've got the people, you take care of the numbers. But I've seen teams come through and what they use is they use their own finance staff. They use their own CFO to do what you're doing. And my experience is that most C-suite and very few below that have ever done more than 2 A's or acquisitions of any kind. Are they really qualified? Are they experienced enough to be doing what you're doing here? Or would it be cheaper, less risky for them to outsource all of this directly to you? I
So
know
I don't
you've got
know.
a vested interest in the response here,
Yeah.
but I'm looking at it, I see a lot of effort go in from the
Yeah.
CFOs and their teams to put all this
Yeah.
together and do the analysis.
Yeah.
But are they really qualified to do it?
So I would say in most cases,
Say
or I
it.
mean,
We're non-political
I would
here.
just
Just
say, I
spit
would
it out.
say in most if they're like most CFOs, they're not really qualified to do it. But the same thing, most CPAs are not qualified to do this because you really need to have experience and you really need to have done at least 5 or 10 before you feel like a little bit more comfortable. I mean, I know from what I do now compared to what I did on job number 5 or job number 50, it's way better. Another aspect to think about is time. I'm pretty fast and I'm an external point of view. So if you have someone within your company looking at it, they're going to be a little more optimistic and they're going to basically make sure that they're not buying something terrible. But they're hoping that the company's good. So there's a little bit of optimism there. I don't care if the company's good in the sense that like if it's bad, I'm gonna tell you that it's bad, and I'm gonna bring up those red flags to you, not to kill the deal, but just so that you're aware. And if the red flag comes to you and you don't feel comfortable anymore, you move on. But that's going to protect your capital so that you can invest in another company. But if the red flag, if I bring it to you and you still like the deal, since I bring it to you so early, it gives you the opportunity to talk with the seller and say, hey, we're going through due diligence. This came up. What are your thoughts? And a lot of times, back to renegotiating, I have found that if you're going to renegotiate, do it before the letter of intent is going to end up, like a lot earlier, as soon as you can. You want to have enough data to renegotiate. However, the earlier, the quicker that you move through the process, the better for everyone involved, and the more likely that it'll close. That's what
I have a different approach in that what I do is I give them an expression of interest for them to fill out and to submit back to me. So it's the other way. I let them say, oh, I'm interested in selling to you, which is rather twisted round.
Yeah. More about that. That's pretty interesting.
Twisted round. But just before I get off that one, then after that expression of interest, a requirement is that they go and use one or two of my people to do the financial analysis and the financial assessment. They get to choose of a panel. And then when we get the numbers back, then we look at the numbers, then do the letter of intent. So that's the approach that I think is far more workable.
So I think because you have such a good brand behind you, you're able to get access to all the data before a letter of intent. One of the challenges, can you get access to all the seller's financials for a letter of intent or an LOI? And a lot of people can't. But it sounds like you found a really smart way of acquiring businesses.
You can't tell. You were talking about sales before. Let's go back to that. You can't tell people anything. They're not going to believe you. However, they believe everything that comes out of their mouth. So if they go off and they get the financials done and they look at the financials and they're not quite what they thought they were, now that they've been professionally done, not done by the Acme bookkeeper down the road. Sorry about that, Acme. Yes. They've been done professionally. Then they get to see the realistic numbers. Then it takes what you were talking about there, the emotion out of it, so that we can look at it and say, okay, that's not right. That's why the number we're going to give you is this number. We would have hoped for something else, but given what we're looking at, that's what we're giving it. But there was one other thing that I wanted to go back on what you were saying there before, and that was the CFOs and their experience. Now, it's not just them. A lot of the times within these businesses, I see that they're under pressure from the CEO, from the board, to actually do this, but to do these assessments at minimal cost. So what they do is they use the internal staff, which is zero cost. Well, no, it's not. You've still got to pay them wages. And they're not doing their real jobs, which means everything's out of whack anyway, because you don't have them just there for doing nothing. You've got them there to do a real job, and now they're doing something else that they're not comfortable with and they're not skilled with, like yourself, and that forces them into a position of getting a lower grade product than what you provide yourself.
And I
That's
imagine
my view.
Yeah. And I imagine a lot of times the CFO is saying, hey, look at this. We want to make sure it's a good thing to buy. And a lower member staff might think like, oh, hopefully it's all good.
A lot of mistakes get made in that respect. Yes, you've got to be able to have done this. And you said before in your intro that you have worked with a number of companies in the past and worked as a team to get these done. So you've got the runs on the board, Caleb, and that really makes a difference, I think. Well, we should wind this up. Caleb, give us your parting thoughts or parting words. What do you want to get across to everybody at this stage?
Buying a business is really fun. You can make a lot of money, but you can also lose a lot of money. So if you get a good quality of earnings report, it's going to help you feel a lot better about the investment you make initially. And then when you turn around and sell the company, it's also going to help you sell faster if you get a quality earnings report.
I think that selling the company side, that is an underutilized thought. And I think that's going to be a revelation to people. I really do. Well, Caleb, thank you so much. I just want to say to people, as my granddad says, why have a dog and bark yourself? Caleb has extensive experience in doing this, focused in on this. We've just got to get this done. If you screw this up, you are going to lose money, you're going to put things at risk, and you're going to lose time, years, making up those numbers to a suitable level again. For the sake of getting it done right, use a professional. And that's why I've really fought to get Caleb on here, because I sought Caleb out to come onto this because of what he did and the very specifics of what he was focused on. So thank you so much, Caleb, for coming along. I really appreciate it. And all your details will be at the end of this, as always. And we should get some more people along to that Thursday meeting. Hopefully not at 1 o'clock, but we'll work that out. Okay. Thank you so much.
Thank you so much.